everybody. I'm John Sirakis, and this is The Climb, brought to you by the Digital Mastermind. This is a show about journeys. It's a podcast where we talk to digital agencies, technologists, marketers, business owners, people that help with whatever it is that you need in your business. And if you want to join a tribe, a group that share the best tips, tricks, tools, there's some mentorship, there's some menteeship, if that's even a word. We stay in constant contact via Slack for all questions and concerns. Go ahead and hit me up. It's our digital mastermind. It's called the digital, or visit us at digitalmastermind.com. But shoot me an email, Jon at digitalmastermind.com. I'd love to hear from you. And remember that this show is live, so tune in with any questions, comments, feedback. We'd love to hear from you, and I'll address any questions as soon as they come in. All right. So it's not the best time of year. We have a Nordic blast, a nor'easter, all these things that are coming. It's a cold place. I'm in Florida, though, and it's a little bit cold for me. It's in the high 40s. But tax season is upon us. So today, we're going to talk about the sexy topic of taxes. But we have one of the best tax guys in the country who I had the honor of interviewing. He's worked for royal families, the mob. So if you want to get out of paying your taxes, this is your guy. All right, all joking aside, he hasn't done that. He's actually a former cop who turned to CPA. It's actually a pretty cool story. If you want to listen to all that, it's on the full episode, which will be posted after this. He's also written a book on tax planning. The name of the book is The Secrets of a Tax-Free Life, Surprising Write-Off Strategies Most Business Owners Miss. And we actually uncovered a lot of those. But, back to taxes. One question that always comes up for me is, what's a comfortable, tax rate that we think that we should pay, right? So, Dave, why don't you come out here and actually let's start with that question. What is a comfortable rate you think we should pay insofar as a tax rate?
0%.
Okay. All right. Well, what is a little bit more realistic and maybe slightly uncomfortable tax rate we should pay?
I mean, 20% sounds fair, but honestly, I don't know. I'm a proponent of a flat tax where we can get rid of all these laws and deductions, and it's just cut 10, 15% a period.
I'd love a flat tax too. I heard that if we did a flat tax, though, that rate would be close to 35 to 40%.
Well, the reality that most people don't understand, and not to get political or anything, but most people don't pay any taxes. So if a flat tax, those people now pay taxes.
Right. So that's the big argument about a flat tax, because it is too much impact. Not trying to get political; these are just facts on the lower economic sector than on the upper economic sector. But the flip side to that is, you hear on the upper economic sector, there's all these massive elite corporations that don't pay anything in taxes.
Right. So that's why all these laws that we have, thousands of pages of tax law, really affect the small business owner, the medium-sized business owner. But then once you get big enough, you hire people like Craig to get you out of paying taxes. So you squeeze the middle guy. The elite can get out of it, and the low doesn't pay anything.
It's like being the middle child, which I am. It's just painful on both ends.
Right.
Some of the averages, though. So the average actually is 21%. They say that people pay in taxes. If you make over $1 million a year, you pay over 33%, I believe it is. And then on the lowest rung, like lower than like $10,000 a year, you're paying almost 0%. Yeah. Of course, you have whatever your state taxes and local things are when you're buying a Coca-Cola. But yeah, it's about 21%. It's across the board. So I think it just depends on where you fall in. I also found interesting, a little bit of research is the average for a small business is 26% that they're paying.
But we're predominantly talking about a pass-through structure, which, for the agencies and what you did and spoke with Craig about, it's really, we're talking about pass-through organizations where the business isn't paying anything.
Right. Yep, so that's where it would be. And some of these businesses, they're pulling in some pass-throughs. I know some people in our group, they're pulling in, probably more than $1 million a year. Not most of them, but some of them. And yeah, at that rate, you're paying, over 33%.
Right. Which is, a topic we've discussed quite a bit on The Climb is when we have profit in our agency, that income gets taxed via pass through to the individual, even though we're keeping the money in the business. So we're getting taxed on it, even though we're not treating it as our money, which is annoying. And I think there is a problem with that. And I guess we
get sheltering though, right? So playing the devil's advocate, like how else would somebody be able to? How else would it be taxed, right?
Well, if we were a S corp, I believe then the business would pay tax on the profit, and then either way, it's getting taxed. I guess it's when you tax it.
Uncle Sam's coming to get their cash,
but it should be tax free as long as it stays within the organization, and should only be taxed when it's distributed to the owner. But instead, we're taxed on it no matter what.
But then people will, and I know some business owners that try to do this, thinking it works. You keep all your money in your business, and you just use all the expenses outside of your business, so they look like they're all business expenses, and you make no salary, right? Because you've just essentially costed everything out.
Well, and like in one of the parts that Craig talks about, it's really about what the IRS expects, and they will not allow you to not take a salary. You have to take a salary that's comparable for the industry in the area of what that salary should be,
and the amount of revenue is also
yeah. So I mean, you could do that, but then when you have partners, it's complicates things, because then you say, hey, but you're prime example, I'm in Jacksonville, you're in St. Pete. St. Pete's more expensive. So if you're taking all your expenses and I'm taking my expenses, well, your expenses are going to be more expensive than mine.
All right. Which also brings up an interesting quandary based on everybody moving outside of all these hub areas, Silicon Valley, kind of getting on a tangent here, but their salaries are technically going to go down because that's how they set their pay scale is based on where they live.
Interesting. I didn't know that. I kind of assumed the people that were, heading towards that remote life are going to be making even more margin.
Might be making more margin. Yeah, I don't know. I think we're gonna have to get an expert on to explain that. But let's dig in. Let's dig into these, and let's start with tax cuts, because not to also be political, but this is probably going to change to some extent. In 2018, tax cuts went into effect for small businesses, and there were a ton of changes. I have some friends that were some CPAs that were banging their heads up against the wall until the last minute. So the question we asked Craig was, so are businesses worse off or better off from the 2018 tax cuts?
Nobody is doing any kind of planning, meaning, they're going on vacation, they're planning a trip. Obviously you got planning that comes around your clients and stuff like that. But nobody was doing any tax planning. It was kind of like, you get your books kept, or maybe you do your books once a year. You go see your CPA once a year, whatever he tells you what you owe. I mean, that's horrible, right? Who likes that guy? So what we do is, first thing we do is we explain to clients, you need to take the time to plan. Because if you take the time, okay, just like everything else you do, you're buying a truck or buying a car, you do some research and you figure out what's going to be the best one for you. When it comes to taxes, you do some planning and you see what works for you. And it starts with, what type of entity are you? All right. There's a couple of different entities. Okay. Sometimes when you start, one entity may be the best, but a couple of years later, it's not the best. And have you ever looked at what type of, can you make a change? Is it a big change? What's it going to save you? So figuring out the entity you're working out, and is it the best tax entity for you, and then making the change if you have to make the change. So that's, I'd say, the biggest thing is failing to plan, and then the entity structure.
That was a great lead in that I should have let in with the right information, because the tax cut is actually the next clip. But at the end of the day, I think it gives a great premise of what Craig Cody, which is a fantastic name, isn't it? Sounds like somebody from like a Western or something. Love that name. It's also an alliteration. But tax planning, right? So this is something that a lot of people just don't even consider, don't even figure, and they don't take the time to do, like he said. And once you have understanding what your structure is, what your goals are, your objectives, professional or even yourself, if you are studious enough at it, can plan those things out, and it's very important.
Yeah, I'd say I kind of tax plan, but I do it more based on comparing to, because he gets into it later, but you end up paying the tax based on your estimated income, based on your previous year. So I do measure against previous year, and then I kind of get a sense of if I'm going to have to pay more or less. So I do probably the lightest amount of planning, and I probably need to start doing more.
Yeah, because and we'll get into it. There's safe harbors for taxes. There's all types of different tax credits, which we get into. But at the end of the day, I think it is important to have a tax professional, and I think that's a great leading clip. The next one is now those 2018 tax the tax cuts that I was mentioning. So if we can get into that clip, that would be great.
State taxes, state real estate taxes, or local real estate taxes, income taxes, you don't get that deduction. What we have found, for the most part, most people that had big deductions when it came to that also were subject to the alternative minimum tax. So they didn't realize, even though they were getting deduction for alternative minimum tax purposes, it was getting added back in. So they may not have gotten the benefit they would have gotten. All right. So, and I will say there's no one that I can remember coming across that was worse off as a business owner based on those 2018 tax cuts.
So if you listen to the full interview, you'll enjoy my confusion when it comes to a specific tax credit, as it explains the meals and entertainment tax credit, which he clears up, and it takes me a couple times to understand it. But I know a lot of things changed based on the way that we wrote things off. But as Craig said, anybody that's enjoyed the last 2 years has had substantially less exposure to tax expenses.
Completely agree. I mean, it's simplified it, and you shouldn't be able to write off Super Bowl tickets. I
wonder why that was in there. Somebody lobbied for that. There was a reason that we were able to write off the entertainment piece.
Because big business used it to schmooze people. I mean, it's another echelon of living that's basically going towards being tax free. Like, that doesn't make any sense. You shouldn't be able to pay for super high end things and then not have to pay taxes on that expense. Like, that's ridiculous.
Do you think religion should have to pay taxes?
No.
It's a weird question, right?
Yeah, but they're not selling anything. It's a donation.
They're not selling anything?
No, it's not a transfer of a product. You're not buying anything. You're not purchasing anything. It's a donation.
My short stint at Walmart, all 3 months of it, I remember these churches would come in and they would just buy like all of this stuff for their houses, what appeared to be their houses. I can't be for sure. And nothing against religion, and it was all religions, right? It wasn't anything specific. But then they would whip out this card that everything was like tax free. It was just amazing. I remember there was this one where it was the lady's kid and he was getting like all these new toys. And I don't know. I'll just never forget that. It just something about it was just, I don't know.
It's the same as if you go to Costco. There's small businesses don't pay tax on their goods. If you go to
Costco, you don't pay taxes on your goods if you're a small business?
If you're a restaurant and you go and buy like a super large jar of mayonnaise and you're going to be using that to make sandwiches at your restaurant, you don't pay sales tax at Costco for that.
Oh, it's because of wholesale?
Yeah.
So do restaurants have a card or something too? Really? Interesting.
They register as that. So when they create their account, they're saying that they're having a wholesale account.
Got it.
Maybe
and I've seen that. I've dealt with other businesses. They said, especially in like the printing, give me your wholesale license or so on and so forth. All right, I digressed. But I think this next clip is speaking to the tax credits and the PPP. So if you want to learn how you can get up to $5,000 or even $7,000 per employee in 2021, check this clip out.
When the CARES Act was first passed, you had the choice between PPP round one or the employee retention credit. with the new bill, you are now eligible for both the employee retention credit if you already had the PPP. And for 2020, that credit can be up to $5,000 per person. So if you had 10 employees and your numbers met the right criteria, you can be getting a $50,000 tax credit. And going into 2021, it's actually a $7,000 per employee per quarter. So you could wind up getting a $7,000 credit in the first quarter per employee, and you could get a $7,000 credit in the second quarter per employee. Whereas in 2020, you can only get a $5,000 total credit, meeting certain criteria. So those are things that if you have accurate books, you could look. You could say, okay, was I down 25%? Was I down 20%? Am I good for this? Do I get this credit? Okay, what do we need to do?
So I know I missed out in the first couple of years based on some tax credits. And Dave, I believe this is a tax credit you told me about. It was a manufacturing or software tax credit, which was a huge savings.
Yeah, manufacturers. So anyone that produces a product, a thing, can claim doesn't have to pay taxes on like the first 20% of their income. Now that went away with the tax with the Trump tax cut of 2 years ago. So you can no longer claim that. But that was something that I learned from somebody at a networking event, and then I passed that on to everybody at DMG. And so, I mean, that little tidbit saved DMG members tens of thousands of dollars over the last 5 years.
And now, and we get into some of these other tax credits, but now I know there's like an R&D tax credit. There's the WOTCs, the work opportunity tax credits, which disenfranchise people, vets, so on and so forth. Yeah, there's a ton out there. And I think it's important to have somebody look and understand all those, because I've always gotten really excited. And a lot of the time, no, there's nothing that even applies to me.
Yeah.
All right. So if you're still thinking about specializing or niching, here's a real short clip that's an argument for it.
Often we'll see, whether it's an agency or another type of business, where they'll do a little bit more specialization and their revenue may come down, but the net number goes up because they're specialized, they're more efficient, they have better systems. And, so I always say it's, what do you keep? And it comes down to the same thing with taxes. Okay. Not so much how much you made, but how much did you keep of that money?
It's a fine line there, right? So it's how much do you want to make versus how much do you want to keep based on the lifestyle of what you want to do. And I still can't find a specialty or a niche where that makes the most sense.
Yeah. I mean, what I take from that clip is, he just wants to, a lot of his strategies need to be specialized so that you can kind of write off things that you probably shouldn't be able to, but you can because of your specialty. Like he mentions writing off buying a boat that's a houseboat that could be classified as a houseboat, and then writing off the mortgage insurance or interest on that. Like there's things like that. I just feel like on a larger company where you have partners, perhaps investors, who's going to let you get away with some of those things?
Man, I've seen. You ever seen a company where it seems like the ownership is just like bananas, like off the wall, and they're like successful despite themselves?
Yeah.
I think it's like some of those, right? It's like Wolf of Wall Street, where it doesn't necessarily mean they're doing something nefarious, but I've been a part of companies where we've worked with them, and I'm like, I don't even understand how this company even functions, because it seems like everybody is just not doing what they're supposed to be doing to make a company successful.
And you've got like shell companies that own. I've had a client that went into a merger, and so they created a holding company that only had 40% owner. I mean, like it was just so many. It gets kind of ridiculous when you really get into it when that kind of stuff happens. But you have to structure that stuff that way for ownership, taxes, all that stuff. I mean, it can get ridiculous. But I mean, God bless if somebody goes through an audit with all that.
Yeah, there's a whole nother realm. Yeah, and I remember it's not in here. I asked him what the audit rate was. He said right now it's, I believe, 0.25%, but they're projecting it to go up to 0.5%, which
Yeah.
that's doubling it, right?
Yeah, but there's 330. Well, there's probably what 200 billion-ish people that have to file taxes. And then how many S corps, C corps, that have to file taxes? I'm still thinking 0.5% is still a lot of audits.
Yeah,
So
that is a lot. I'm not going to attempt to do the math. I do that just each time and embarrasses myself.
right.
But speaking of audits and paying those taxes, so some of us, pay once per year. Some of us push out our taxes with an extension. But is that good advice? And another great question to that is, how often should you pay taxes? This is what Craig said.
The IRS says, other than withholding, all right, your payments should be paid quarterly. So April 15th, June 15th, September 15th, and January 15th. They want their money quarterly because they have their bills to pay. All right. If you don't do it that way, there can be a penalty. Okay. Now, some people don't mind paying $1,000 penalty if they have use of that money for the year, and some people don't want to pay a $5 penalty. So it comes down to, people want to have that money in the bank. Okay. We like to use, you may have heard of Profit First. We like to use that with clients so that they, even if their estimates may be based on last year's tax, their income is up 25%. So, relatively speaking, their tax is going to increase. So we may only be making estimated payments based on last year, but we have that money sitting aside in a tax account. So we'll be good. So when we have to make that payment in April, we're not wondering where we're getting this money from. All right. So that's all part of the process. You want to make sure you're setting aside the right amount of money. All right. So you don't want to know, I owe $100,000 and I don't have anything. I spent it all. Okay. And they may have spent it on a business. They may have bought equipment. They may have done a number of different things, but you want to make sure that you have that money set aside, and, nobody should have that surprise. I mean, too often you'll hear, my CPA called me up on, April 10th and told me I owe $75,000. We do projections now, the end of December, beginning of January. So I can tell you, it looks like you're going to owe this, or you're paid in, you're fine, or whatever it is. You're knowing you have to make that payment. You may not like making the payment, but it's much better to know today and have 3 months to plan for it. All right. Even if you have it. All right. Than to know a couple of days before.
I always think of Wesley Snipes when I hear about the account that you need to make sure you don't get hit with this giant tax bill. I mean, didn't he owe like $8 million or something like that and have to go to prison for a few years?
Yeah. So on this topic, with saving rates so low, I see no reason why you would not make a payment and not just go ahead and pay it. I mean, holding cash right now is worth less. So now, if we are up at a more traditional 6%, and I'm going to have to pay $1,000 fine on, let's say, $1 million, then I'm making, 50,000 off interest. So that I completely understand withholding until, you have to pay. But now, I mean, just pay it, get it off your books, and move on to the next quarter.
Yeah, agreed. Yeah, there's no reason to hold it. There's no gains. And I know some people will just push out extensions. It's just delaying the inevitable. Some people say that their books aren't adjusted. I would look at, all right, what is the interest rate going to be based on you pushing it out versus what is the cost to readjust your books if you have to add something into one of the last months.
And one little, since we did touch on politics a little bit, a lot of people say when they're not happy with an election, they're like, I'm not going to pay my taxes. And little do people know that our tax money doesn't go to government spending. Like the federal government doesn't need your tax dollar to spend, because your tax payment goes to the Treasury, which pays for the Fed, and the government just borrows whatever it wants to spend. The funding for government always comes from borrowing, not from your tax dollars. So if there's anyone out there going, I'm not sending in my tax payment, well, it doesn't matter. They're still going to spend.
People say that? I haven't heard that.
Yeah. That's part of like Wesley Snipe was like he was like doing he was a tax rebel or something like that.
Tax dodger.
Yeah. So
all right, old Blade dodging his taxes.
Yep.
All right, so now let's get into deductions. These are some of the meaty things that you can walk away with and actually have a real impact on your tax exposure. So let's start with the one related to working remote and with COVID. So let's go ahead and play this clip.
So having a home office now allows you to write off a home athletic facility, all right? And down in Florida, okay, if you have a pool, it gets expensive. So, and then we have clients where they've set up video studios in their garage and stuff like that. All that stuff, formerly nobody was deducting. It's legitimate, okay? Deduct them. So we talked about home office. There's your car and truck expenses. You know, now if you have a home office, you're actually traveling from one office to another, right? You're not commuting. You're traveling from an office to another. So now those deductions that you may have been doing that weren't really legitimate become legitimate. So it really comes down to making sure you're doing what you should be doing, okay? And not just writing the check, documenting while you're writing the check, making sure you have all the documentation.
Home office, a pool. I'm going to write those things off. I don't have a pool, but I do write off a home office. I do have a home office, and I deducted it per square footage every year. I don't know if I did that last year. Did the tax law change? No?
What's that?
You didn't do it last year?
No, because I never worked at home. But now this year, I'm definitely doing that because I had to create an office. I had to, rededicate space in my home for everyday work. I mean, we worked easily 6 months without going into the office. And I mean, only just recently have we started coming back into the office. But everyone that is, in the organization worked from home now. So I'm going to take some of the kitchen square footage. I'm going to take some of the bathroom square footage and my entire room that I'm dedicating to my office, because it is, if my kid can't come in, then it's not part of the home. So
that's the filter, right? The kid can't go in there. It's part of the office that's going to be written off. You got a gym in there? He said you could write that off too, a home gym.
Don't have a gym, but even back
weights, just get a couple weights.
Even before COVID, it still had to be dedicated space. Like if you worked off your kitchen table, you can't claim the kitchen, the kitchen table. Like you can't claim the family room but if you had a room that's dedicated to work, then you can write off that part of the mortgage. And then whatever that percentage is, make sure you take the electric bill, your water, sewage, trash, like any utility, you get to deduct that percentage as well.
Yeah, I have two, an office for my wife and myself in the home. And I think I did last year. Just, I don't know. When it comes to the tax stuff and me paying out, it's one of those like painful types of things that I don't really, capture the whole memory of. But I think that's a great tip. And especially if you have a pool, if you have, a workout room, people up north with basements, geez, like.
But a great tip there is also that you're commuting between offices, not driving to work. If you're driving to work, you can't claim any of that. If you're commuting between offices, you can. So that's a great tidbit right there.
That is a great tip. My drive is only 3 minutes though.
Mine's only 5. so it's not going to be worth it for me to keep track of, because he did said in one of the clips that we didn't include in this, document everything, and you better be able to back it up. So if you're going to claim a $2,000 deduction for commuting, you better have a mileage log, or there's apps out there that help you track that, but you better have something. You can't just say it
if they audit you, because you technically just say it. You just write it down in a box.
Well, I mean, my guy that does my taxes just simply won't allow me to do it. I mean, I'm like, come on, can't you do illegal stuff here? Can't you, just go ahead and do it? And he just won't allow it. But To be honest, I never actually asked him to do illegal stuff. So,
little disclaimer comes across the bottom.
right. Now I'm on that audit list. Damn it.
Yeah. All right. So sticking with deductions, how about the top deductions that agencies should be making this year?
We've talked about qualified business income deduction, which there's some planning that you should be doing for that to maximize that. Retirement plans. Okay. So often overlooked, maybe you have a safe harbor, 401k or something like that with a 4% match, but when you start to pay a lot of tax, maybe you should be looking at, a profit sharing plan. All right. Or maybe you should looking at a defined benefit plan. And these are plans where we typically want to see the majority of the money, okay, going to the owner. All right. As a business owner, you're paying unemployment insurance, just paying benefits, you're paying all these things. Okay. Now, okay, let's try and put more money into our retirement savings if we can. So, and sometimes it could be a chunk of money. I mean, we just did work with a client where they're getting 96% of the defined benefit contribution. So that's, so should they pay almost 40% tax, or should they give 4% to the employees? I think it's pretty much a ground ball. So, so retirement plans. Then we have, family employment. Okay. Is your spouse involved in the business? Are they not getting paid? Maybe if you hire them, if they're doing work, if they're not working someplace else, and, now you could get, put more money away into retirement for them. Are your kids involved? You could pay your kids up to $12,000 a year and they pay no federal income tax.
I think my father did something with it. He had there was 3 boys. I was the middle one. We all worked for him. And I got a feeling there was a tax write-off or a tax credit somewhere in there, other than the low cost of the labor that we provided. But you could do this with your kid, right? Did you hear what he said and the way that you could structure this?
But you know what I wish you would have asked him, and I don't even know if he's familiar with it, but how does open book management work with paying your kids to launder tax money?
I don't think the word launder is not.
Oh, it is laundering. 100%.
How is it laundering money? That's not.
You're a digital marketing agency, and you're paying your 11-year-old to do what? To hide $12,000 in revenue. That's all it is.
Laundering money is washing money. So you got it in ill-gotten means, right? And now you need to clean it to get it into the.
That's what you're doing. You're sending it through a payroll company to your 11-year-old child. That is laundering money. The point of laundering money is to get it tax-free. Is to, spendable tax-free money.
So baby Emma is not going to be on the open book management roster
because I think you're stealing from the budgets of your team. So all these things, all these tax strategies work really well with a sole proprietor, where you're just,
But let's say you have someone that's making $100,000 a year. You minus their salary by $12,000 to pay the kid. Well, that $12,000 would be then tax free. So there's a gain made on the 100. So
Correct.
The person now making 88 rather than the 100.
Right.
But
they're only paying taxes on 88.
Right. Exactly. Yeah.
If that's not money laundering, then I don't know what is. I mean, it's in the tax code, so it's legal. I get it, but the reality is, so again, if you've got a larger team, and now a team's coming to you and saying, "Hey, we need to hire more people," and you're like, "Hey, we can't afford it," and they're like, "Well, what's your 11-year-old doing for the mission that we're on?" I feel like those practices, things like that, will lead to almost like a morale deteriorate. I don't know. I would not.
You're right. It's going to make it look shitty to your staff, right? It's like, what does little Timmy do in the office with his toys that he's pulling a paycheck, especially if you have the open book management side, which I think is a great argument for the open book management. But, and this isn't something, maybe I did in the full interview. I can't remember. I know some people will write off their dogs because it's as a utility because they're technically security.
You used to do that.
I know some people that do that.
I remember you telling me that like 6 years ago, and I'm like, "What are you doing?"
No, it was actually 8 years ago. It's no longer in the statute of limitations. Let's cover that. No, but I had an accountant that was the one that like all these things. I was just so surprised. I was like, okay. She's like, you got dogs, right? I was like, yeah. I go, all right. Well, all right. How much is everything? Like we totaled up everything. She's like, okay, this is security write off. And I was like, okay, this sounds great. All right, let's keep this going.
Yeah.
Which spawned my question for the 2018, by the way, of the Trump tax cuts, because it's a completely different book, right? Because a lot of those things that happen, I don't know if the dogs one is in there. I have a new account, thank God. That they changed where you can't do a lot of the things that you used to be able to do.
Yeah, but you also don't have to pay taxes on the first 20% of your revenue, period. No hiding it, no coming up with shady things.
Wasn't hiding it. It wasn't shady. I was following the code of the law based on a professional that signed off on my tax returns.
Yeah. Yeah. I mean, I'm definitely going to look for anything related to the home office because government basically said, stop coming to work. Mm-hmm. So I am going to maximize the hell out of anything related to my home. So
you're getting a pool.
I wish I had a pool. I could maybe my.
Have you ever had a pool?
Yeah. Well, my parents. I've never.
I had one. First house. It was terrible. Like I had to clean that thing. I had to pay for that thing. It was like having a relative that just wouldn't leave. That just ate all your food and money. Couldn't stand that thing.
I mean, you should have just hired a pool company and wrote it off. So I mean,
I didn't have Craig Cody in my life.
For one of the things that I do, I have to do a lawn service for my rental property because the lot is so large. It's an awkward like cul-de-sac lot, but it's huge, and nobody has unless you had a riding lawnmower. Which who has a riding lawnmower if you're renting? You can't cut it, so I just have to include that as part of the price. Well, I write that up. That's 100% write off. I got anything related with that rental property gets written off. So
it's a business.
Yeah, correct. So you have to look for anything. Any expense that you put into a rental property is a write-off. So,
but all the things that we're saying and the whole reason we should have a flat tax because correct. It's complicated. It's this game that people try to win at, and the game is how do you spend or pay as little as possible based on this rule book that these accountants and do you know
why billionaires like
paid a ton of money to do? Not that Craig gets paid a ton of money. He's underpaid. He's a great guy. Hire him. But
billionaires like Warren Buffett and Jeff Bezos and all these billionaires that are advocating for rich people should pay more. They are saying that because they know that they're going to have the people that'll figure out how to get that number to zero. And they'll have the documentation to do it. So they're like, yeah, squeeze the middle guy more because not everybody can afford a Craig Cody. But what we're doing is we're underscoring the value of a Craig Cody, right? He can reduce your tax bill. And if you're paying a significant amount of tax, which we are, as a small business, we should look at, adding that to what we're doing. Maybe more tax planning, but then again, all these strategies reduce the amount of cash flow you have in the business. So like the example he mentioned about the profit sharing, I looked into that. And at the end of the year, you can, and as he mentioned, 4% went to the employees. You can push money into employees' accounts and then you can super overfund your owner account. But now you can't touch that money again. So if you run into a COVID and you need cash flow, can't touch it. So
what accounts do these sit in? I'm not following.
You can do what's called a profit sharing, and you can do it, I think, through your 401k. But basically, at the end of the year, let's say you've got $1 million in the bank, and you want to have it without paying taxes on it. You can put $200,000 in your owner 401k. And then throw like $20,000 in, your key personnel 401k accounts. And that's great. And that's tax-free money. But now you can't touch that until you're 65 without
Right.
penalty.
It's tax-free until you're 65.
Right.
You're going to
But
get
now,
taxed on it.
but now let's imagine a 2020 comes along and you're a small business owner and you're like, holy shit, I need to cover payroll. Well, you don't have that cash flow now.
Yeah.
So,
and that's the gamble. That's why I think the best thing is to always have enough cash on hand to take care of any problems that come your way.
right. That's a good lead into our next clip, but I'll let you tee it up.
Well, the next clip also happens to be the last clip, and I want to be so thankful for Craig's time to let me interview him. He's a great guy. I highly recommend that you check out the full interview. But the last question was something I ask a lot of people: ideal profit margin for an agency. This is what Craig said.
Think, a 25% is the number you want to look at. And, into that, you can also adjust officers' compensation depending on where an officer's, how much compensation that officer is taking and stuff like that. But 25% is a nice number.
25%. I think last week we heard you can get amazing percent with our episode with Allison Caffrey, the operations agent. She said you can get, I believe it was 45% if you have really smooth running operations and if you're niche focused, right? So Craig here says 25%. And Dave, I believe we're at 26?
Yeah, we came in just at 26, so feels good in a pandemic year. Yeah, I mean, you can't complain about that. 25% sounds right. I mean,
yeah.
50% sounds amazing. But
people say, oh, yeah, we're making like 50, 60% margins. And it's just, that's like unfathomable to me. Just wow. Worked with one company that was an education company online. It was subscription based, and his margin was like 90%. And he was doing, like $500,000, $600,000 a month. It was just insane.
Well, that's why that's the allure of the online platform margins. They are making those crazy, insane margins because there's no factory producing a widget. It's just ones and zeros in a database.
No widgets whatsoever. Just taking the money. The social media, for instance, right? Subscription based, fantastic, platforms, and it just sounds like easy street to me. Just haven't done it. Just doing everything the hard way. I have a friend. Good.
Think about this. The shift over the last 6 years, a lot of people don't realize this, but Silicon Valley used to sell software. Software was a product. Products have sales tax. Everything goes to service-based SaaS model. All of a sudden, your Adobe Photoshop is no longer subjected to sales tax because it's a service, and services aren't taxed, don't pay sales tax. So think of all the tax dodging that has happened just based off a word. It's still software. I installed it. It works just like it used to, but now since it's billed monthly and part of a Creative Cloud, it's no longer applicable to sales tax. So
technically, it's like product leasing.
Correct. Yeah, but they're dodging, all those sales tax for state sales tax and federal sales tax on those products.
Yeah, that's so upsetting. I think we should do 2 more clips.
2 more? Let me see if I can find one.
All right. There's a clip where I asked, and you brought up these, important points where, a lot of agencies don't have a CFO. A lot of successful companies do, though, right? And a lot of the agencies don't because they're too small. But I think it's important, to understand the function of a CFO. And I know, a few really, really great ones. I mean, if you can find it, this is what Craig said about CFOs.
Really following what's going on. Okay. So they want to have a good grasp of, cash flow. All right. Making sure, it depends on what the owner's doing. Okay. How much time does the owner have to spend on things? We'll come.
I say they have no time.
Right. You need somebody that's looking at your receivables, your aging of your receivables, your payables. I mean, so often we'll see where, we'll come in and, nobody has, because everyone's busy, not because somebody's slacking off. Nobody's looking at the aging. So you might be 6-9 months out, and nobody's reached out to this person. Maybe they've gotten the invoice, maybe they haven't gotten the invoice, but it's much easier if somebody's 90 days or 60 days net to reach out to them 90 or 120 days than 6 or 8 months later, because maybe they didn't get the invoice, maybe it got lost, who knows? So that's one of the functions of your CFO, is making sure all your accounting and finance operations are updated and kept on top of. And there's different levels of service that can be brought to bear against that. But you want to get paid, especially when you're doing work, and you don't want to be writing off invoices because it's too long, or maybe they're not a client anymore, or there's a number of different reasons and things that happen. So being on top of that, so it's costing you more money, but you're not writing off all that money that you were writing off every year. Another thing, are you accrual basis? Are you cash basis? We like to see agencies their books kept on accrual basis, but maybe their taxes don't need to be kept on accrual basis, because, do you want to pay taxes on money you haven't received yet? So from a business owner standpoint, you want to know accrual, because that's really the most accurate way to view what's going on. But from a tax basis, I don't want to pay Uncle Sam until I actually receive the money.
Old Uncle Sam. Now, what I think about, what's interesting about the CFO side of things is what that function really does, right? You're managing, cash flow, you're looking at those things, but it's also continually looking for places where you can save, as he mentioned. And there's fractional CFOs. If you want to save money, I know there's some that it's, I think, as little as like $2,000 to like $4,000 a month, where you're getting somebody that's executive level, that's worked for multi-million-dollar corporations, and in some cases, some really big enterprise firms. The other thing too is I've seen, based on negotiating terms, I've seen some CFOs do some remarkable jobs there, where you may owe something that's going to be net 30 based on your supply, or with some of your vendors, and they're able to create specific terms. Also with media companies, I've seen some fantastic jobs there as well. Now, getting into the next clip. So this is in the DMG. I'm going to give a shout out to, he's actually somebody else that we interviewed, Lee Walkner. He gave some similar advice to this, but this is what Craig says. If you're on the fence about whether you should apply for any federal aid, this is what Craig says.
Why not take it? Okay. I mean, there were a lot of people, first round that were not sure whether they were going to apply for it. Okay. There were people that applied for it, were not sure if they were going to give it back. Okay. And you're not lying. You've met the criteria. The government says we want, trust me, you've paid a lot of money in tax over the years. All right. Somebody's going to pay for that in the future. So, and it's probably going to be you. So if you're entitled to it, I believe you should apply for it, but everybody can do what they want.
Go get that money.
You
never know
that money.
You never know what's going to happen in the future. So if there's a law that says you're entitled to this credit or this whatever, take it, store it, and if shit hits the fan, you're okay.
Yeah. And they're saying you can't do certain things, but we're going to give you this in lieu of the things that you can't do. I think you should absolutely go and get as much as you possibly can.
So this, combined with what I said earlier about the Federal Reserve and the government just borrows it, a lot of people, they feel that this is a moral conundrum where they're like, oh, but I don't necessarily need it, and I feel like it's scamming. They're going to spend the crazy amount of money no matter whether you take it or not. You are not affecting the federal government's budget. You are not keeping food off of some starving kid's plate at public school. It has nothing to do with any of that. Get your money.
Yep.
And donate it.
They're screwing that kid other ways. They've stolen that money for years. This isn't, I agree. That is good advice.
If it's a moral issue, then donate it yourself. But get it out of the federal into the hands of real people then.
Yeah, I think it's so weird. And when it comes to business, a lot of people are making, like you said, it's a moral conundrum. It's not moral at all, right? It's not a right or a wrong situation. It's, what works and what doesn't work.
It's
And
what's legal and what isn't legal.
well, they're telling you can't do certain things. It's been impacted based on regulations, and I'm not saying anything. I mean, COVID is a terrible situation, but these are the remedies that they're putting in place. And as I said earlier, the more cash that you can have on hand to deal with your problems, the more solutions and better outcomes you're going to end up with.
100%.
Oh, yeah. So. Thanks for finding those other 2 clips. I think really appreciate it. The other thing too is give the full episode a listen if you want to know more about Craig Cody, or you can contact him. Dave, I believe you put that in the message of this episode. I'll make sure that it's in the show notes for wherever everywhere else that we load the show, iTunes, YouTube, so on and so forth. But other than that, he could go ahead and check out his book too. I heard it's a great read. I honestly haven't had a chance to read it yet, but I will. And we just announced the Vegas registration for the early bird rate. So with the early bird rate, go ahead and check out the website for the event. If you're a DMG member, if you're not, go ahead and contact me. Jon, Jon, at digitalmastermind.com, where there's some things on the website where you can sign up, digitalmastermind.com. And other than that, thank you so much for watching. Really appreciate it. And go have some fun. Take care. Bye now.